Cryptocurrency trading. This isn't just some quick overview. We're doing a comprehensive guide. We're going to break down what it is, how it works, the different ways you can trade, and most importantly, how to navigate the often wild west of the crypto markets without losing your shirt. We'll cover everything from the absolute basics, like what spot trading even means, all the way to understanding the charts and managing those heart-stopping risks. So, if you've been curious about crypto, maybe you've heard stories of people making fortunes, or maybe you've heard the horror stories of people losing it all, well, you're in the right place. Today we'll dive into the essentials of crypto trading, covering everything from basic strategies that even a complete beginner can understand, to the kind of risk management that the pros use. My goal here is to give you a solid foundation, a real understanding, so you can make informed decisions for yourself. We're not about hype. We're about real talk and real strategies. We're going to look at the potential rewards because, let's be honest, that's what draws a lot of us in. But we're also going to spend some serious time on the risks, including some recent major events like the WazirX hack, because ignoring those is a one-way ticket to financial pain. By the end of this, you'll have a much clearer picture of what crypto trading entails. So, grab a coffee, get comfortable, and let's get into it. And hey, if you appreciate this kind of deep dive, do me a favor and gently tap that like button. It really helps out. We're talking about things like Bitcoin, Ethereum, Solana, Dogecoin, you name it. If it's a digital currency or token, it can probably be traded. This all happens on various platforms, usually called exchanges. Think of them like the New York Stock Exchange, but for digital money, and they operate 24/7, which is a whole other beast we'll get into. The big draw? The opportunity for profit, sometimes very significant profit, if you play your cards right and the market moves in your favor. But here's the catch. And it's a big one. It comes with some serious, and I mean serious, risks. We're talking about market volatility that can make your head spin. Prices can skyrocket one day and plummet the next. Then there are the security concerns. These are digital assets, and hackers are always looking for ways to get their hands on them. And let's not forget regulatory uncertainties. Governments around the world are still figuring out how to handle crypto, and new rules can pop up that dramatically change the game. So, while the upside can be tempting, you absolutely have to understand the downside. It's not just about pressing a buy button and hoping for the best. Alright, let's talk about one of the most common ways people get into crypto spot trading. Now this is probably the most straightforward approach, and honestly, it's where most people start, and for good reason. Spot trading involves buying and holding the actual cryptocurrencies themselves. So if you buy one Bitcoin on the spot market, you actually own that one Bitcoin. You're not just betting on its price, it's yours, sitting in your digital wallet. The main idea here is that you're anticipating the price of that crypto to appreciate, to go up over time. This method really appeals to long-term investors, the hodlers as they're called in the crypto world, hold on for dear life. They believe in the technology or the future value of a particular coin, so they buy it and plan to hold it for months or even years, hoping it will be worth a lot more down the line. It's less about quick flips and more about a long-term investment strategy. Because you own the actual asset, you can also use it for other things like staking or participating in DeFi, but for trading purposes, it's about buying low and hopefully selling high, but with the actual coins in your possession. Chapter 4. The nitty-gritty. How does crypto trading actually work? So, how does all this crypto trading actually happen behind the scenes? Well, one of the most defining features is that crypto trading operates 24/7, 365 days a year. Unlike traditional stock markets that have opening and closing bells, the crypto market never sleeps. This means traders can engage literally any time, day or night, from anywhere in the world. This constant activity is a big part of what makes it so dynamic and also, frankly, a bit exhausting if you're not careful. Transactions are typically executed through what are called order books on centralized exchanges. These order books match buyers with sellers. If you want to buy Bitcoin at a certain price, you place a buy order, and the exchange looks for a sell order that matches. It's a constant dance of supply and demand. There are also decentralized platforms, or DEXs, where trading happens more directly peer-to-peer using smart contracts, but the principle of matching buyers and sellers is similar. Beyond just simple buy and sell orders, traders can utilize tools like leverage, borrowing funds to increase trade size, which is super risky, set up advanced order types like stop losses or take profits, and implement various risk management strategies to try and enhance their trading outcomes and protect their capital. Chapter 5. Reading the Tea Leaves, Technical Analysis for Crypto Profits. Alright, let's get into one of the main tools traders use to try and predict where prices are going. Technical Analysis, or TA. This involves looking at price charts, historical price data and trading volume, and then applying various indicators and patterns to identify trends and potential trading opportunities. It's all about studying the past price action to try and forecast future movements. Key concepts you'll hear about include chart patterns like head and shoulders or triangles, candlestick patterns which give clues about market sentiment, and identifying support and resistance levels. These are price levels where the market has historically struggled to break above or below. Then you have things like trend lines which help you see the general direction of the price, and volume analysis which can confirm the strength of a move. Traders use a whole arsenal of popular indicators to help them make sense of all this. You've probably heard of some moving averages like the 50-day or 200-day, the Relative Strength Index, RSI, which can indicate if an asset is overbought or oversold, MACD, Moving Average Convergence Divergence, Bollinger Bands that show volatility, and Fibonacci retracements which identify potential reversal levels. The goal is to use these tools to make more informed trading decisions based purely on what the price action is telling you. Chapter 6. Beyond the charts, fundamental analysis in crypto now. While technical analysis focuses on charts and price action, there's another whole school of thought called fundamental analysis, or FA. This is about digging deeper into the actual project or cryptocurrency itself. Instead of just looking at price patterns, fundamental analysis considers factors like the strength of the network, how many users does it have, how secure is it. It looks at protocol upgrades. Are they making improvements to the technology? It scrutinizes development activity. Is there an active team building and innovating? And it dives into on-chain metrics, things like transaction volume and active addresses, which can give you a real sense of the network's health. The goal of fundamental analysis is to get insights into the intrinsic value and, crucially, the long-term potential of a cryptocurrency. Is this a project that's actually solving a real-world problem, or is it just hype? Beyond the project-specific stuff, FA also takes into account broader macroeconomic trends. Things like inflation, interest rates, and global economic health can all impact crypto prices. Regulatory developments are huge, too. A new law can send prices soaring or crashing. And finally, institutional adoption. When big companies or investment funds start buying crypto, that's usually a pretty strong signal. It's about understanding the why behind the price. Okay, we've talked about the potential, but now it's time for a serious reality check. Crypto trading is packed with risks, and you absolutely need to understand them. First up, market volatility. This is the big one. Prices in the crypto market can and do fluctuate wildly and rapidly. We're talking double-digit percentage swings in a single day sometimes. This can lead to significant gains, sure, but it can just as easily lead to massive, devastating losses if you're on the wrong side of a move or if you panic sell. It's not for the faint of heart, and you need a strong stomach. Then there are the security risks. Exchanges and individual wallets are prime targets for hackers and fraudsters. These are sophisticated criminals, and even major platforms can be vulnerable. For instance, a really stark reminder was the 2024 WazirX hack, a major Indian exchange, which resulted in the loss of approximately $234.9 million. That's a staggering amount, and it shows that even established players aren't immune. And let's not forget regulatory uncertainty. The rules are still being written in many parts of the world. This lack of clear, consistent regulations can expose traders to unexpected legal and financial risks. For example, in the UK starting January 1, 2026, HMRC will require cryptocurrency users to provide detailed personal and transaction information. This is aimed at curbing tax avoidance, but it also highlights how quickly the landscape can change. So let's try to put it all together and look at the pros and cons of crypto trading, because it's definitely not a one-sided coin, pardon the pun. On the pros side, the most obvious is the high profit potential. There's no denying that some people have made life-changing money in crypto, especially those who got in early or timed the market incredibly well. Then there's the 24/7 market access, which we talked about. For some, this is a huge advantage, offering flexibility. You also have relatively low entry barriers. You don't need a fortune to start. You can often begin with a small amount of money. And finally, for more advanced traders, there are leverage opportunities, which can amplify gains, but also losses, so it's a double-edged sword. Now for the cons, and these are significant. As we just hammered home, high risk is at the top of the list. The volatility means you can lose money just as quickly as you can make it, if not faster. Then there's the potential for market manipulation. Because some parts of the crypto market are less regulated, and some coins have low liquidity, prices can sometimes be manipulated by large players, or whales. We've already covered security concerns extensively. Hacks, scams, phishing attempts are rampant. And regulatory issues are an ongoing concern. A sudden change in government policy can have a massive impact on your investments and your ability to trade. It's a high-stakes environment, no doubt about it. Given all those risks we just talked about, if you're even thinking about trading crypto, risk management isn't just important, it's absolutely essential. This is how you protect your capital and stay in the game long enough to potentially see some profits. First up is diversification. Don't put all your eggs in one crypto basket. Spreading your investments across different assets, maybe some Bitcoin, some Ethereum, maybe a few promising altcoins, can help reduce your risk if one particular coin tanks. Then there's hedging. For more advanced traders, using instruments like options or even futures carefully can help offset potential losses in your spot holdings. Another critical strategy is using advanced orders. Specifically, learn to use stop-loss orders. These automatically sell your crypto if it drops to a certain price, limiting your potential loss on a trade. Take profit orders do the opposite, locking in profits when a target is hit. A very popular guideline is the 1% rule. Never risk more than 1% of your total trading capital on a single trade. This helps ensure that a few bad trades don't wipe you out. You also absolutely need an exit strategy. Before you even enter a trade, you should know your target profit and your maximum acceptable loss. And finally, due diligence. This means doing thorough research before investing in any cryptocurrency. Understand the project, the team, the tech, and the risks. Don't just buy something because someone on social media hyped it up. Okay, so after all that, if you're still interested and you understand the risks, how do you actually get started in crypto trading? Let's break down some practical first steps. First, you need to choose a reputable exchange. There are tons of them out there, but you want to stick with well-known, established platforms. Think names like Binance, Kraken, or Coinbase. These generally have better security, more liquidity, and more user-friendly interfaces, especially for beginners. Do your research on fees and the coins they offer too. Next, and this is crucial, secure your investments. Don't just leave all your crypto sitting on an exchange if you're holding for the long term. Consider using hardware wallets, which are physical devices that keep your private keys offline and away from hackers. And always enable two-factor authentication on your exchange accounts. When you do start trading, start small. Seriously, begin with a modest investment, an amount you can genuinely afford to lose without it impacting your life. This allows you to learn the ropes without catastrophic consequences. Educate yourself continuously. Utilize resources like Binance Academy, TradingView for charting, and countless other educational websites and communities. And finally, stay informed. The crypto market moves fast. Monitor market trends, news, and developments regularly. Knowledge is your best defense and your best tool. Alright, that was a lot of information, but hopefully this gives you a much more solid and realistic understanding of what crypto trading is all about. The good, the bad, and everything in between. We covered the basics, different trading types, how to analyze the market, the massive risks involved, including that WazirX situation, and how to potentially manage those risks and get started if you choose to. My goal, as always, is to arm you with knowledge so you can make smarter decisions with your money. Thanks so much for watching this comprehensive guide. If you found this video helpful, if you learned something new, or if you just appreciate the effort that goes into breaking all this down, please do me a solid and smash that like button. It tells YouTube you liked it and helps the channel grow. And of course, share it with anyone else who might be curious about crypto trading. Don't forget to subscribe and hit that notification bell so you don't miss out on future videos where we'll dive even deeper into specific strategies and market analysis.